January 28th, Bank of Canada rate decision day. And for the first time in a while, everyone agrees on what's going to happen. Nothing. The Bank of Canada cut rates 7 times in 2024 and 2025, 275 basis points total, and now they're done, at least for now. But here's what nobody's talking about. While the Bank of Canada sits on its hands, the Fed is expected to keep cutting, and that changes everything for your mortgage strategy. Let's break it down. So what's happening on January 28th? The Bank of Canada is expected to hold the overnight rate at 2.25%. This isn't a surprise. Governor Macklem basically telegraphed this in December when he said, and I quote, a policy rate at the lower end of neutral is appropriate. Here's what that means in plain English. The bank cut rates as much as they think it can safely without risking a comeback in inflation. They're at the bottom of what they consider neutral. BMO's calling this the start of a long pause, and they're not alone. The consensus from the big bank economists is that the BOC holds steady throughout most, if not all, of 2026. But here's where it gets interesting. While our central bank is parked, the Fed is expected to cut 3 more times this year, bringing their rate down to around 3%. That's going to narrow the gap between Canadian and US rates. And historically, when that happens, it puts upward pressure on the Canadian dollar, and that can influence our bond market, which means potential movement in the fixed rate mortgage, even if the Bank of Canada does nothing. Let's talk about what this means for your mortgage. Starting with variable. If you're on a variable rate mortgage or considering one, here's the reality check. The prime rate in Canada is currently 4.45%. With the BOC on hold, that's not changing anytime soon. Your variable rate payment stays where it is. Now, some people may be wondering, could the Bank of Canada actually raise rates this year? Believe it or not, there's a small contingent pricing this in. CIBC put out an interesting piece this week asking whether the Bank of Canada could run out of room, meaning could the labor market tighten enough that the bank needs to tap the brakes? Their answer? Probably not. The unemployment rate is still a full percentage point higher than pre-pandemic levels. There's slack in the system. Wage growth is tame. They don't see a hike happening until 2027 at the earliest. And even that's conditional on the economy heating up more than expected. Scotiabank is a bit more hawkish. They actually see a rate hike in the back half of 2026, taking us back towards 2.75% by year end. But even they're not expecting anything until the second half of the year, and only if the CUSMA negotiations go smoothly and the economy picks up steam. Bottom line for variable rate holders, expect stability for the next several months. Don't count on more Bank of Canada rate cuts, but also don't panic about hikes either. Now let's talk about fixed rates, because this is where it gets more nuanced. Fixed rates are tied to bond yields, not the Bank of Canada rate directly. And bond yields are influenced by a whole bunch of more factors, including what's happening south of the border. Here's the setup. Canadian 5-year bond yields have been hovering in the mid to high 2% range. With the Fed expected to cut rates while the Bank of Canada holds, BMO expects the Canada-US spread to become less negative over time, moving from around minus 75 basis points toward maybe minus 60. In English, Canadian bonds become relatively more attractive, which could put some modest downward pressure on yields, and therefore some modest downward pressure on fixed rates. But don't expect dramatic moves. The economists are generally calling for Canadian 5-year yields to stay pretty tight in a range between 2.8 and 3.2% throughout the year. So what does that mean for your 5-year fixed mortgage? We're probably looking at rates staying in the 3.8 to 4.2 range for the foreseeable future. Maybe some modest improvement, but nothing dramatic. If you're shopping for a fixed rate right now, the best monoline rates I'm seeing are 3.79%. That's likely close to as good as it's going to get for a while. Let's connect this to the housing market, because that's where the rubber meets the road. Scotiabank just released their December housing data and tells an interesting story. National sales down 2.7% month over month, down 4.5% year over year. The MLS Home Price Index down 0.3% in December and down 4% for the year. Now here's the context that matters. Yes, prices have fallen almost 19% from the peak in early 2022, but they're still up nearly 30% higher than pre-pandemic levels. So if you bought before COVID, you're still way ahead. The market conditions right now are what I'd call balanced nationally. The sales to new listings ratio is sitting at around 52%, right in the middle of the range. But there's an interesting regional story here. BC and Ontario markets, particularly Vancouver, the Fraser Valley, Toronto, Barrie, and Guelph, those are tilting toward buyers. 7 of the markets Scotiabank tracks are officially in buyer's market territory. Meanwhile, the prairies and parts of Atlantic Canada are still favoring sellers. Calgary, Edmonton, Regina, Saskatoon, Halifax, and Quebec City, these markets are tighter. What does that mean for your mortgage strategy? If you're buying in a buyer's market like the GTA or Vancouver, you have more negotiating leverage on the price. If you're in a seller's market in the prairies, you may be paying closer to asking, but the trade-off is those markets have seen better price appreciation. The forecast for 2026, Scotiabank expects a modest recovery in prices, but we're talking sub 2% nationally. Don't expect a big bounce. The markets need time to absorb all the rate cuts we've already had. Now, there's one giant asterisk on everything, and that's spelled CUSMA. The CUSMA review is scheduled for mid-year. If those negotiations go sideways, if we end up with significant new tariffs on Canadian exports, all bets are off. CIBC put it bluntly this week. Until a trade deal is reached, capital spending by Canadian businesses will remain hampered by uncertainty. That's a drag on the economy. That could keep the Bank of Canada cautious for longer. On the flip side, if trade tensions escalate, we could actually see the Bank of Canada cut rates again as an insurance against sharper downturns. So that's the range of outcomes. Base case, rates hold steady. Upside, modest hike if the economy surprises to the upside. Downside is more cuts if trade talks blow up. For your mortgage decision making, the takeaway is this. We're in a period of relative stability, but there's more uncertainty than usual lurking in the background. If you have a renewal coming up, don't wait until the last minute. Start shopping around 120 days out so you have options if the situation changes. Quick look at what's coming this week that could move markets. Monday CPI inflation data for December. Consensus expects it to hold steady at 2.2% year over year. If it comes in hot, that could support the rates staying higher. If it's cooler, that gives the bank more flexibility. Friday, November retail sales. The headline is expected to show a 1.4% bounce, but economists are warning that volumes are still weak. Consumer spending has been soft, and of course, January 28th, the Bank of Canada rate decision itself. I'll be back with a breakdown as soon as that drops. All right, that's your mortgage rate outlook for this week of January 2026. Quick recap. The Bank of Canada is expected to hold at 2.25% on January 28th. Variable rates are stable for the foreseeable future, and fixed rates are likely to stay in a narrow range with modest potential for improvement. The housing market is balanced nationally with regional variations, and a modest price recovery is expected. And that big wild card, CUSMA negotiations, could change everything. If you're trying to figure out the best strategy for your situation, whether to lock in fixed, ride variable, or time your renewal, that's exactly what we do here at Everyrate. We shop 30 plus lenders to help you navigate this stuff. Links in the description. Subscribe and hit that bell if you want to see these updates weekly. I'm Andy, and this is the Mortgage Rates Weekly. See you next time.